The stock market is a vast and unforgiving ocean, and the amateur trader arrives at its shores in a vessel built of hope and flimsy intentions. He believes that his desire to succeed is enough, that his native intelligence will see him through. He does not understand that the market is not a place for good intentions, but for ironclad rules. It is a battlefield that demands a strategy, yet he arrives with none. This is the first and perhaps most fundamental mistake a trader makes. He engages in the most challenging game in the world without a plan. He is not a speculator, he is a gambler. He acts on whims, on sudden impulses, on the thrill of the moment. His entries and exits are governed by the erratic tides of his own emotions, not by a predetermined, tested set of principles. He tells himself he is being intuitive, but in reality, he is simply being aimless, a ship without a rudder, destined for the rocks. The master speculator, the one who survives and prospers, operates from a different reality entirely. His every move is dictated by a clear and rigid set of rules, rules forged in the fire of experience and paid for with the cold, hard cash of past mistakes. He does not need to think in the heat of the moment, for he has already done his thinking. His plan dictates his actions, and he follows it without deviation. The amateur, lacking a plan, is a slave to his every emotion. The professional, armed with his plan, is the master of his emotions. He has outsourced his decision-making to his own higher, unemotional self, the self that created the rules in the cold light of reason. This is the great chasm that separates the consistent winner from the consistent loser. A trader without a plan is a soldier who wanders onto a battlefield without orders, a map, or a weapon. His defeat is not a possibility, it is a mathematical certainty. The first step toward professional speculation is to cease being a gambler and to become a strategist, and a strategy begins with a written, inviolable plan. The second great mistake, born of arrogance, is the trader's desire to fight the trend. He sees a stock that has been declining sharply and believes he is a hero for trying to catch the bottom. He sees a market that has been roaring upwards and believes he is a genius for trying to call the top. He is not following the market, he is arguing with it. He is trying to impose his will upon the tape, to bend the market to his own opinion. He does not understand the most fundamental law of speculation: the tape is always right. The market moves along the path of least resistance. The speculator's job is not to create the path, but to identify it and walk upon it. Jesse Livermore understood that the great money was never made by buying at the bottom or selling at the very top. That is a fool's game, a pursuit of vanity. The great money was made by identifying the primary trend, the great bull or bear wave, and riding it. He was not a hero, he was an intelligent follower of the market's own leadership. The trader who fights the trend is like a man trying to swim up a powerful river. His efforts are exhausting, and his progress is negligible. The speculator who joins the trend is like a man who puts his canoe in that same river and simply steers. The immense power of the current does his work for him. To insist on picking tops and bottoms is to make the market your adversary. The wise speculator makes the market his greatest ally. He waits for the trend to declare itself, and then he aligns his capital with that irresistible force. That is the beginning of all wisdom in the market. The third mistake is a speculator's mortal sin, an act of financial insanity that is responsible for the destruction of more accounts than any other. It is the practice of averaging down, of adding to a losing position. It is the act of throwing good money after bad. The amateur buys a stock. It drops. Instead of accepting the small loss, his ego is wounded. He cannot admit he was wrong. To prove his original judgment correct, he buys more, lowering his average price. He tells himself he is a savvy investor, getting a better bargain on a stock he already liked. Livermore knew this for what it was: the reinforcement of failure. The trader is not investing, he is subsidizing a mistake. He is sending his precious capital, his soldiers, into a battle that is already being lost, hoping to turn the tide through sheer, stubborn force. This is a strategy for ruin. The master speculator operates on the opposite principle. He never adds to a losing position. Ever. He cuts his losses without hesitation. He adds capital only to his winning trades. He pyramids on strength, not weakness. He sends his soldiers to reinforce his victorious generals, not his failing ones. Averaging a loss is a habit rooted in hope and ego. It is a denial of the facts being presented by the ticker tape. The speculator who commits this sin has already lost the battle, for he has chosen his own opinion over the market's supreme verdict. The fourth mistake is the evil twin of the third. While the amateur holds his losers with stubborn hope, he cuts his winners with trembling fear. He finds himself in a profitable trade, and the fear of losing that small profit becomes unbearable. He cannot stand the nervous strain of success. He sells the position, snatching a meager gain, and breathes a sigh of relief. He tells himself, "You can't go broke taking a profit." While this is true in the most literal sense, it is also the philosophy that guarantees a trader will never become rich. His small profits will inevitably be consumed by one of his large, hope-fueled losses. Livermore taught that the great money was made by sitting tight. It was made by having the courage and the patience to ride a winning position through the heart of a major move. He understood that it was never his thinking that made the big money for him. It was his sitting. His profits were rewards not for his action, but for his inaction. The trader must have the nerve to hold his winners and the discipline to cut his losers. The amateur does the exact opposite. He holds his losers and cuts his winners. His portfolio becomes a garden where the weeds are carefully watered and the flowers are pulled up the moment they begin to bloom. The mathematical outcome is inevitable. This approach guarantees failure. The fourth mistake is the failure to understand that the purpose of speculation is not to make a great number of small, nervous profits, but to capture a few, great, decisive moves. The fifth mistake is a product of mental laziness, the trader's reliance on tips and the opinions of others. He lacks the confidence to do his own thinking, so he seeks shortcuts. He listens to the experts on television. He scrolls through social media. He asks his broker for a hot stock. He wants someone else to do the hard work for him. He does not realize that he is playing a sucker's game. A genuine tip, one based on real inside information, is almost never shared with the public. What he receives is either a guess, a rumor, or, worse, a deliberate piece of manipulative information designed to make him the bag holder. Livermore was a supreme individualist, a lone wolf. He knew that to succeed, a speculator must do his own work. He must study the tape, learn the behavior of stocks, and form his own conclusions. His successes were his own, and his failures were his most valuable teachers. The trader who relies on tips learns nothing. When a tip works, he feels like a genius, but his confidence is false. When it fails, he blames the source of the tip, accepting no responsibility. He is doomed to remain a financial infant, always dependent on others for his next move. To trade on another man's opinion is to admit that one has no sound opinion of one's own. It is an abdication of responsibility, and the market is merciless in its punishment of such weakness. The sixth mistake is the addiction to constant action. The amateur feels he must be in the market at all times. To be in cash feels like a missed opportunity. This itch for action is an emotional need, not a strategic one. It is the impulse of a gambler, not the discipline of a speculator. This forces him to trade on minor, meaningless fluctuations. He buys and sells on wiggles, getting chopped to pieces by commissions and the bid-ask spread. He is not speculating on the great trends. He is gambling on the random noise between them. Livermore understood that most of the time, the correct course of action is to do nothing at all. He would wait patiently, sometimes for months, for the market to set up for a major, decisive move. His capital was his ammunition, and he refused to waste it on minor skirmishes. The successful speculator knows that opportunities are like buses. There is always another one coming. There is no need to chase every single one. The key is to wait for the right one, the one where the probabilities are overwhelmingly in his favor. This requires immense patience. The trader who overtrades is treating the market like a casino. The house, in the form of commissions and the inherent statistical odds against short-term trading, will always win in the end. He is bleeding his capital dry, one small cut at a time. The seventh mistake is a product of a powerful and destructive force, the human ego. The trader begins to personalize the market's movements. He believes the market is a living entity that is personally out to get him. He feels that they are hunting his stops. This is a form of supreme arrogance. The market does not know that the individual trader exists. It is a vast, impersonal force, the sum of the hopes and fears of millions. To believe it is targeting one small speculator is to have a delusional sense of self-importance. This ego manifests in other ways. After a string of wins, the trader starts to believe he is infallible, that he has figured out the game. He abandons his rules, he increases his risk, and he begins to trade with reckless abandon. He has forgotten the virtue of humility. Livermore knew that a speculator must remain humble, always remembering that the market is the final authority. A loss was not a personal insult, it was feedback. It was the market telling him that his judgment was wrong. He listened to this feedback and adjusted his position accordingly. The trader who lets his ego rule his decisions is doomed. He will refuse to take a loss because it is an admission of error. He will double down on a bad trade to prove he was right. He is no longer trading the market, he is trading his own pride. And pride always, eventually, leads to a fall. The eighth mistake is the failure to properly manage risk and preserve capital. The amateur is focused entirely on the potential profit of a trade. The professional is focused, first and foremost, on the potential loss. The amateur will risk a huge portion of his capital on a single sure thing, hoping to get rich quick. He does not understand that in speculation, there is no such thing as a sure thing. He is exposing his entire career to a single roll of the dice. Livermore's primary rule was capital preservation. He knew that a speculator without capital is like a general without an army. He is out of the game. He therefore managed his risk with extreme care, never risking more than a small percentage of his total capital on any single idea. He understood that losses are an inevitable part of the business. The key is to keep them small and manageable, so that they are more than covered by the profits from the winning trades. This is simple mathematics, yet the amateur consistently violates it. The trader who does not make risk management his highest priority is not a speculator. He is a thrill seeker on a short and certain path to financial oblivion. The first job is to survive, and survival depends on disciplined risk control. The ninth mistake is a form of tunnel vision. The trader analyzes and trades a stock in a vacuum, ignoring the general market conditions. He finds a stock that looks bullish on the chart, but he fails to notice that the overall market is in a steep decline. He is trying to swim against the tide. Even the best-looking stock will struggle to advance in a powerful bear market. The great wave of the general market will overwhelm the small ripple of the individual stock. Livermore's method was always a top-down approach. First, he would analyze the general market to determine its trend. Second, he would identify the strongest groups within that trend. Only then, as a final step, would he look for the leading individual stocks within those leading groups. He understood that even a mediocre stock in a strong group will often outperform a great stock in a weak group. The speculator must have the wind of the overall market at his back. To ignore the general conditions is to ignore the most powerful force that will determine the outcome of the trade. The trader who makes this mistake is like a man who carefully selects the most beautiful deck chair on the Titanic. His specific choice may be excellent, but his failure to observe the general conditions renders it tragically irrelevant. Finally, we arrive at the 10th and ultimate mistake, the emotional sin that underpins all others. It is the act of hoping. The trader enters a position, and it goes against him. The tape, the one true authority, is telling him he is wrong. But instead of listening, he begins to hope. He hopes the news will change. He hopes the market will reverse. He hopes that some unseen force will intervene and rescue his mistake. He has abandoned the realm of science and entered the realm of faith-based pleading. Livermore knew that hope has no place in the mind of a speculator. It is a poison. It is the denial of fact. The tape deals in facts, and facts alone. Hope is an emotional fantasy, a refusal to accept the reality that the market is presenting. The disciplined speculator acts on the evidence of the tape. The amateur acts on the feeling of hope in his heart. This is the final, great dividing line between the professional and the gambler. A trade that requires hope to become profitable is a trade that should be exited immediately. The professional acts on what he sees, not on what he wishes to see. By banishing hope, he keeps his mind clear, his judgment sharp, and his capital safe. Hope is the currency of the loser.